Hi, my name is Chad Kozlowski, Senior Loan Officer with Residential Mortgage Solutions, and I'm here today to talk to you a little bit about some of the different loan programs that majority of you will be proceeding forward with when purchasing a home. So we're going to talk first about the FHA versus conventional loan options. So a lot of misinformation out there. Neither of the two options are necessarily better than the other. It's all about what's going to work best for you. So some of the main bullet points that you're going to look at is going to be FHA loans, government-backed loans by the Federal Housing Administration tend to be a little less restrictive than your standard conventional loans. Those are not backed or insured by any government agency, so the requirements are typically going to be a little more stringent than that FHA option. That would include FHA being a little more liberal with the lower credit scores, whereas conventional loans will hold you to a higher standard in most cases. Both options will, however, have monthly mortgage insurance providing on the down payment you put down. So your standard down payment on both options, FHA will be 3.5%, whereas a conventional loan will allow down as low as a 3% down payment, but generally it's going to be closer to 5%. So somewhere between 3 to 5% is your down payment on the conventional loan option. The monthly mortgage insurance will vary between the two as well. FHAs are more cut and dry. It's a standard rate based on the loan amount that you're borrowing. Whereas conventional loans, that mortgage insurance premium can fluctuate and be dictated off of your actual credit scores. So the higher the credit, the lower the premium. The other option when it comes to mortgage insurance, difference rather between the two is going to be the upfront mortgage insurance that FHA loan will require you to pay, which will increase your total finance loan amount, whereas conventional does not have one. Conventional loans will also have mortgage insurance drop off a lot quicker than an FHA loan would. FHA loan requires a minimum of 11 years, but can go up to as much as life of the loan if you're putting down anything less than 10%, which majority of people will be. Conventional loans, however, once you get sufficient equity, 20% equity in a home, whether that comes from a larger down payment or from time of living there, making the payments, paying the mortgage down, you can eliminate that premium a little bit quicker. Some other differences that we're looking at between the two of them is going to be seller's concession. So buying a house, putting in a contract, the sellers can pay for a portion of your closing cost. Not always a guarantee, but it is an option. So if you're looking for a minimum out-of-pocket expense, FHA a lot of times is going to allow for the seller to pay a larger percentage than a conventional loan will, which will keep your total out-of-pocket expense to a minimum.